Hello everyone, my name is Tanvi and I am presenting my presentation on the topic Excess Equity ETF FOF NFO. So the reason behind this presentation is to get an overview about this kind of a mutual fund that Excess Mutual Fund Company has presented before of us. So let's go ahead to get an answer for my tagline, that is just an overview about really investors should go for it, or is just uh, other things for the other people. So the framework for my presentation is, the first thing that we should get to know is the meaning about this kind of a mutual fund. Then what exactly ETF means for. Then the other one is the investment objective. Then fund details, and last but not least, the final takeaway for this presentation, that is who should invest in such funds. So the first one is excess equity ETF FOF NFO meaning. So excess equity is an open-ended fund, fund of fund, and its underlying scheme is predominantly investing in units of domestic equity ETFs. So here the fund company would take your investment money and they will invest that part of it or the whole of it in the whole index of ETFs. Either they could take the ETFs of their own excess company or in other mutual funds as well. Excess equity ETFs FOF intends to offer a combination of both the active and the passive management strategies by investing predominantly in units of domestic equity ETFs of Access, ENC, or any other mutual funds. So, with passive management strategies, excess equity ETF would have a very low risk when it comes to a security selection, because in passive investing, this fund follows the indexes, the Sensex indexes like Sensex, Nifty, etc. If index goes up, then that passive investing would go up. And in that regard, the fund manager would bring changes in a mutual fund only when there is a certain change in the index. So we come to the third point, that the fund manager will actively decide upon the allocations to a particular market cap. That could be any cap, because here the investment is done dynamically. It could be a large size market cap, mid size market cap, or a low size market cap, and they will pick the sectors or themes to invest in. The underlying exposure themselves would be the passive in nature due to its ETFs tracking the particular market cap or sectoral or thematic indices. So that's what excess equity ETFs is coming for the first time in ETF way. Now, since we are studying it in differently with respect to an ETF, everywhere we are saying ETF, ETF, ETF. So what does it mean? ETF is an exchange traded fund. It is a mutual fund structured to track the performance of an index by simply replicating and mirroring the index in portfolio. So normally we buy mutual funds from the mutual fund company, but in the case of ETF, it is different. That is, we'll be buying and selling stocks in the stock exchange, and selling stock in the stock exchange. Or usually, most of the ETFs or index funds or simply replicate and mirror the index in its portfolio as it is mentioned in the PPT. So, passive investors or the people who are not actively taking part in the stock selections or want to avoid risk in stock selection, would prefer passive investment approach. Passive ETFs would be their preference. Why it would be their preference? Because they got low expense ratio with ETFs. That is, there is a wide range of investment choices and diversification they are getting it. So two advantages they were getting it, that is the low expense ratio and wide range of investment choices and diversification. And exactly. So when it comes to the selection of an ETF, the thing which should kept in mind is the impact cost gap. What is that impact cost gap? Impact cost gap comes in ETFs, and this impact cost is of less liquidity of the ETFs. And that liquidity is always available in the open-ended funds. And in our first slide, we have read that the Access Equity is an open-ended fund. So impact cost, the study of that impact cost is really important for an investor or an early investor to know about before investing in such kinds of mutual funds. Next is the objectives, investment objectives specifically. What objectives would be fulfilled if this mutual funds comes in a rise? So this investment predominantly is done in the units of the domestic equity ETFs. Domestic equity ETFs. Why it is so? What company will do is company will get the fund from you and they will invest it without any analysis in the whole index. If Nifty 50 is there, then Access company would go with the whole 50 companies ETFs or any other mutual funds of it, and they'll invest it. And if there is a change in an index, only then your mutual fund portfolio would be get changed by the fund manager. So here is a predominantly in units. So this is a passive investment. And next is to generate low term capital appreciation. Third one is eliminating the risk of security selection. As I have said, the investor have no doubt, have no further consideration that in which security he or she needs to invest in. He gives his money by way of an ETF mutual fund, ETFs to a company. Now, company would invest that money in a whole index. So, what kind of whole index? As per the market capitalization, it's their botheration, not mainly of the investors. Next investment objective is that to aim for minimum tracking error. कंपनी कहाँ इन्वेस्ट कर रही है दैट मस्ट बी इन ट्रैक, और वो ट्रैकिंग एरर जो है वो कम से कम आना चाहिए, मिनिमल ट्रैकिंग एरर. The other one is about the fund details. Now here we will see the NFO snapshot. Now what NFO is the new fund offer? Now this Access Equity ETFs FOF is the name of a fund whose period comes from 4th February to 18th February 2022. This is a period in which you can, this is the NFO period exactly if I say. The investment objective here is to provide the long-term capital appreciation by investing predominantly in the units of domestic equity ETFs. The benchmark, this will provide this standard against which the mutual fund would be get measured. That is your Nifty 500 total return index. Now in today's time, mutual funds benchmark is usually PRI, but here they are taking TRI as their benchmark. And In an Axis mutual fund company, the fund manager would be your Shreyas Divalkar. He has a great experience for you, but that doesn't matter because market is very dynamic when it comes to its changes. So let's move on to our next point, that is the exit load. There is a complete redemption. If that redemption is done within 15 days from the date of allotment, then the exit load would be of 1%. Otherwise, thereafter, they would be nil. Tax treatment: if units are get sold after 1 year, 10% tax would be get there. Otherwise, sold within 1 year, then 15% tax rate would be available for the investors. Now, for knowing who should invest in this Axis equity ETFs or who shouldn't, for that they will go for a detailed analysis where somewhere pros and cons would come over here. So when it comes to the pros and cons, the first point is that adds low cost passive investments to your portfolio. Low cost because they are going to invest in index fund. Next is can avail systematic investment plans options. More transparent portfolio when compared to active mutual funds. So when you compare your portfolio to an active mutual fund portfolio, the index fund would have transparent portfolio. Why? Because here the exact rates will get mentioned as of the index. Can reduce the impact cost for the investors. They have the potential to reduce the impact cost for the investors. There is a minimum tracking error and also will give you the exposure to multiple equity ETFs in the market. Also will provide you the lower expense ratio. These are the pros. And when it comes to cons, let's go ahead with it. That is, first is, see, active mutual funds can pick and choose the best stocks in an index and construct a portfolio, so they have better chances of generating return. And that is what is got less potential compared to the active mutual funds. Less potential to returns compared to active mutual funds. Second point, investment on the basis of floated adjusted market capitalization. Simple selection of ETFs is done so on the basis of float adjustment market capitalization. Thus, there is no analysis we get done. When in an ETF fund, there is no calculated risk because they are investing without any analysis in which ETFs they are investing, what is the technical analysis, what is the outlook, what is the future trading regarding to it, what is the past of that stock. So such kind of analysis is not get done when it comes to an ETF. So risk cannot be calculated, or is just not calculated, we could say. And also the most important thing, that these mutual funds are not suitable for the short-term investments, are not suitable for the short-term investments. Now, the final takeaway of our PPT is to know, now, should we invest in this fund or to avoid in this fund? So investors who do not want to invest in active funds may invest in these ETFs FOF because there is minimum risk in security selection and they would get it what they want in an easy way. Even if you are going for these kinds of index funds, ETFs, better to go an existing ETFs with less expense ratios and less tracking error. As for this, ETFs, we can wait for this some more time. Why? Because we need to know that do they have an expense ratio, what kind of expense ratio they have, or because ETFs have